Okay, thank you very much. And I'd like to call to order the special called investment committee meeting for January the 18th. We are expecting a quorum here momentarily. And we have two items on the agenda to discuss, but first we need to have a roll call. Oh, we
Do you
need
want-
to, I'm sorry, we need Vicky to do the opening statement.
Yes, sir. For the record, I want to note that this is a special called meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And would Sherry like to do the roll call for us, please?
Sure. Mr. Lane,
Here.
Mr. Atkins,
Here.
Miss Bova,
Here.
and Miss Thompson.
Here.
Thank you.
And I believe that makes us, Vicky, a quorum. Is that correct?
Correct.
All right. And I've been told we have no public comments, so we will move forward. We have two items on the agenda, both one of which is globally important. The other is just very important. So we'll move on to the asset allocation analysis. And there is no set schedule for when we revisit the asset allocation analysis, but I believe our last one, Steve, was 5 years ago. Is that correct?
The asset liability was almost 5 years ago, yes.
And I have to say it was an interesting time because it was hard work to reach our expected returns, and with interest rates being so low. But there are several reasons. One is 5 years is a long time in the investment world. But secondly, there's been obviously a sea change in interest rates, and that will affect an asset allocation analysis significantly. And so we chose to revisit now. And Wilshire has been working with our staff for quite a time here, and we've had some back and forth. When your stock market moves so much, your bond rates move so much, future returns are certainly some combination of art and science. And I think we've got reasonable numbers, which we'll talk about here, but this is critically important, as we all know, in the investment world, and all of you are in it. Asset allocation is a real determinant of your success or failure long term, and ours has been working well for us. It was also affected I guess, the effect of our low funding ratios was still really on our minds when the last one was done. We have made significant progress, and I will, as always, congratulate our legislators for their yeoman job in upping our maintaining our full funding, and that has also helped us make significant progress in our underfunded status. So, Steve, you want to take it over from here with?
Sure. I just want to give a brief introduction before turning it over to Wilshire, and just to clarify. So for the full asset liability work was done a little longer ago. The asset allocation work was more recent. However, the point still holds that capital market assumptions have changed materially since that last asset allocation analysis was performed for the systems. And as Pruitt mentioned, the most notable changes have been in the expected returns for fixed income specifically, and other asset classes that have a yield component. As we all know, rates have risen sharply and quickly from their former zero bound. So all of fixed income as well as anything with a yield component is offering much more attractive risk return profiles than even 2 years ago. These changes in the markets are really offering an opportunity to build efficient portfolios. What we looked at were portfolios with meaningfully lower expected risks while maintaining similar levels of expected returns and similar liquidity profiles, which we know are important for our less funded portfolios. Mitigating the risk and potential magnitude of significant drawdowns in the portfolio should markets experience large sell-offs, and really improving the probability of achieving the assumed rates of returns of the portfolios over the longer term. The only real last thing I would highlight is that we used a very thoughtful approach in developing, as Pruitt mentioned. There's been a lot of back and forth discussion with Wilshire and with Pruitt in developing these asset allocation recommendations. If we were to allow the model to run unconstrained, the results, the outputs, and the efficient frontier would look drastically different than what the recommendations were going to make. For instance, some portfolios would currently have zero public equity exposure. That's not something we thought was prudent. So, we implemented constraints in the modeling that reflect staff's views and expectations for markets, as well as recognizing there's significant costs to making drastic changes to portfolios. That's not something we want to do. If we do, we want to leg into changes, do what's prudent. There's cost, especially with the private markets, and as we've seen in significant timing lags in implementing those, whether it's increasing or decreasing allocations to those markets. So we're very thoughtful in our considerations in what we thought was prudent. And in this, I do view, while there's not a timing element to, I think that for us, the drive and when we want to relook at asset allocations, or when there are significant changes in the markets or in the status of the systems of the portfolios. And obviously, I think with this timing is important given the current changes in the market. But it doesn't have to be, an all at one time. We can look at a stepwise change. So, it's not something, if there's significant changes in the markets between now and 2 years from now, we'd look again. If there's, 12 months from now, we wouldn't look to implement significant draconian changes, but maybe do it in more of a stepwise and prudent manner. So with that, I'll turn it over to Wilshire to jump into their presentation.
Okay, Steve, thanks. This is David, and great opening comments by both you and Pruitt. It just set the stage really well for what we're going to present today, what we've been working on for quite some time, as you mentioned. First, I'll just introduce on our team. We have four of us are with you today. The three faces you usually see: Craig, Chris, and me. In addition, we have Ned McGuire on with us. Ned leads our asset allocation team. He's an actuary himself. Our team works extensively with your actuary in going through the asset liability study. And as Steve mentioned, from time to time we do we call it an asset only review, where we'll review the asset allocation, look at it for efficiencies, etc., but not really connected to the liabilities. When we go through an asset liability study, that's the reason this presentation is some 80 or 90 pages long. There's a whole bunch of stuff in here, and we'll go through what we need to in order to just help step you through this decision. But all of the connect of your liabilities happens in this asset liability study. So Ned will take us through quite a bit of that. And if we can go, Sherry, to that slide 5, I'll just say a few things here. A lot of good things were said already about this. The opening point that asset allocation is the most important decision an investor can make. We've all been hearing this for decades now. This was proven decades ago. We continue to state it because it continues to be true. And we will actually statistically look back and analyze this. And it still continues to be the most important decision you make. So just know that as we go into this, that's why it is a critical thing that you spend time on. And we state that, it should be done every so often, every 3 to 5 years, maybe earlier, maybe later. That really varies depending on market conditions and depending on the demographics of your liabilities. So there can any time be a need to go back through this. And so, but what's important about it is that it's not, we don't intend for this to be, when we talk about it being the most important decision you make, we don't intend for that to mean that you should be constantly visiting this, unless you're trying to do that from a tactical perspective, but from a strategic perspective, this is still long-term work. And as we develop capital market assumptions, we do that every quarter, but those are 10 years looking forward. So in all of that process, we don't develop capital market assumptions that are short-term. We do develop views that are short-term relative to, say, a strategic policy benchmark. But our capital market assumptions are 10 years and looking forward. So just keep that in mind when we talk about, Pruitt mentioned we've had a sea change. We absolutely have had a sea change. If I think, I'll bet everyone on this call in all of the, however many decades we've been in this business doing this work, looking at asset allocation work, we have never had a regime shift like we just went through. And if you go back to, so we stayed on here, Pruitt and Steve were mentioning it, the last full asset liability, that was actually November of 20. So even less than 5 years, about, closer to like 4 years ago, November of 2020 was the last full asset liability study that was pre-separation of K and C. And if you go from then until today, it's just been a huge regime shift. Back then in 2020, what we were talking about was the investor's challenge. And we sort of adopted that phrase for that. And that challenge was that there was nowhere to go to get yield, as Steve was just talking about. We had interest rates at zero. We had an assumption for 10 years forward on core fixed income that was below 1%. So we had the most asymmetrical trade in fixed income that we've seen. And you can go back, 1980 essentially is the peak of interest rates. So we've got like a 40 plus year cycle where rates have come down. But what we've seen in the last 3 years has been the most intense and rapid move of all of that. So we've gone from a place just 3 years ago where rates were near zero, fixed income basically didn't really have utility for us. One, it didn't give us any expected return. Two, it was so asymmetrical that it wasn't providing the hedge that it should provide to growth-oriented assets. So that's where we were when we went through this study in November 2020, and then it rolled into the early part of 21, I think, when the policy was finally adopted, et cetera. And back then, we were trying to get some expected return. You, as well as funds all over the country, were challenged to even meet a discount rate. I remember the graphs. We put a paper together every year on asset allocation of major retirement systems all around the country, and we'll always graph sort of the average expected return of all of these plans, which used to be up around 8%. Now it's closer to like 7%. And then we would plot the allocations of 100 and some plans, and 90% of them were below that expected return just based on their asset allocation, like they weren't going to get there. So that was the challenge everyone faced in that 2020 time period. Since then, we've moved short-term rates up 500 basis points in about a year and a half. And so there's the regime change. It's a whole different world today. At the same time, we've had equity valuations just go through the roof. So as you look forward from a 10-year perspective, we've been talking more lately about the shrinking of the equity risk premium. And by that, we're just saying, we don't mean next week. We don't mean what happens in 2024. We're referring to, if you look forward today over 10 years and look at the current valuations of equities, and then build that out with an assumption model, us and many others like us that produce capital market assumptions, you get to a point of X. And then when you look at fixed income and the yield today and step that out over 10 years, you get to Y, and the difference between X and Y today is below 1%. So the equity risk premium is hugely challenged today looking forward. That speaks right to what Steve was saying about talking about opportunities to reduce risks. So we'll be talking about that here. We'll step through a whole lot of things today. as Steve mentioned, your staff and us and Pruitt, we've gone round and round through several discussions evaluating this data. We've looked at fully unconstrained models. Just like Steve said, where would your assets be if you had no constraints? They'd be in some different places than they would be right now if you had no constraints, at least from an expectation or a mathematical perspective. So the opportunities on the next slide, just again, looking at this, the opportunities are this. You have the opportunity, and you're not alone in this, actually. Funds all over the country have this opportunity today. Fixed income is back. It's providing utility. It's a whole different story than it was 3 years ago. And we've talked about these shrunk equity risk premiums. And so you have the opportunity today from a longer term perspective to look carefully at asset allocation, and you can find ways to be more efficient. So we can, reaching assumed rates of return today in general for plans is much easier. Depending on what that assumed return is, it's much easier. And you can do it more efficiently, and you can do it with a lower level of risk. And so you might say, well, what do I really care about that? What you care about that is that if you can achieve where you need to get to with some lower level of volatility, it's going to help tremendously to reduce that risk you have. We refer to it as drawdown risk, downside risk, but what happens to you in an environment when growth assets sell off in a big way? And that's always been a problem for asset owners. It's always been a problem for investors. And so if there's a way to protect some of that downside a bit and still achieve what you need to achieve, those are important things to consider. And so we'll look through that today. And Steve said we're gonna show some other policies that do exactly that, reduce risk and operate in a bit more efficiently. And I'll just headline over on slide 8, headline the recommendations that we're going to talk about, and then we'll come to those in detail. But we're recommending that you adopt one of the lower risk policies that we'll step through today. We've spent a lot of time with staff and looking through these policies, and with our team and even our asset allocation team. So there are a few options here for the different systems, those that have a 5 1/4 discount rate, those that have a 6 1/4, and then also the insurance plans. So you'll see that as we go through, but the important things to just kind of plant in your thinking as we go through. You have the opportunity to earn expected returns now that are in excess of that assumed rate. And we can do that while reducing growth factor exposure. We have a piece in here where we talk about this process is not just a mean variance analysis. We don't want to just look at an efficient frontier and make all of our decisions based on that. There are many other things we look at, and one of those that's really important to us is growth and inflation. That just those two factors, where we boil down the whole world into two things: growth and inflation. These are economic factors. How does your portfolio fare when inflation is rising, when inflation is falling, when growth is strong, and when we're in a recessionary environment? How does it fare now? So we're gonna look through things like that, but you have the opportunity to get to those expected returns, even beyond that a bit, and reducing some of that growth factor exposure, which is exactly what will help you in an economic downturn situation. And then finally, there's liquidity that's important to you. You can do this in a way that will modestly improve liquidity. And then also the Sharpe ratio, which is just a risk-adjusted return. How efficiently are we able to make our assets work? So all of those are opportunities, and we'll step through the details of what we've modeled and what we think you can focus on for decision making. So if we go over to slide 10, we're going to pick up there. And Ned McGuire that I mentioned is going to take us through this section, and then later again we'll come back to him, and he's going to walk us through a lot of liability modeling and what a lot of these simulations look like.
Great. Thank you, David, and thank you everyone for being here this morning. Hopefully this is a slide that's not new to the committee, to those on the call. This is a slide that we put together several years ago, really helping plan sponsors like yourself focus on the decisions that are most impactful, as the slide title says. So in this funnel chart, with all investors, we start with what the objective is. You run a pension plan. The objective is to fund and pay the promised benefits to participants when they are due, namely when they are retired. The second level down in light blue, asset allocation, that is what we're going to focus on today. As David mentioned earlier, this is the biggest driver of variation in a portfolio's return. In a 1980s paper, which seems hard to believe, that's almost 50 years ago, Brinson, Hood, and Biebauer determined that 90% of a portfolio's return variation is determined by its asset allocation. So this long-term asset allocation that we are looking at today. The second to the bottom portion in red is the investment structure. Once we have set the asset allocation, the investment structure really is to, within equities, decide between U.S. equity and international equity, within U.S. equity between large and small, and then to get to a more granular level between growth and value. And this portion of this asset allocation process drives about 5 to 7% of the return variation. And then finally, the bottom piece in green, manager selection, really drives the remaining 3 to 5% of the return variation. On the right-hand side of this triangle, you can see various words in blue, different shades of blue. These are our Wilshire's risk lenses that we'll talk about on the next slide. So if we can move to the next slide. Several years ago, a group of us at Wilshire met to discuss what are the common risks that all investors face. This is both institutional and individual investors. And so we've really broken it down into two high-level categories. The light blue or teal is organizational risks, those being behavioral issues and maybe shortfall issues. Shortfall, David touched upon a little bit earlier, and that's really not getting an annual return equal to your expected rate of return. So expected rate of returns being somewhere between 5.25 and 6.50% for the plans that we are discussing today. Behavioral issues, this is why you have an investment committee. So one person's biases don't rule the portfolio. And so we have a diversification of thought and ideas when building these allocations. And the other four risks really are common investment risks to everybody. Drawdown risk, selling when assets are depressed, inflation risk. As David touched upon a little bit, our growth and inflation factors will consider this. Liquidity risk, trying to sell illiquid assets when you really can't without taking a haircut. And finally, active risk, the decision between active and passive management with investments. And then finally, at the bottom, there's emerging and long-term risks that affect all of these risk lenses throughout an organization and an individual. So if we move to the next slide, here's a pictorial of our asset allocation process on the left-hand side. The three key inputs at the top, I'm sure that David, Craig, and Chris have talked to you extensively about. Wilshire's capital market assumptions. As David mentioned, we update these quarterly and publish a paper annually. The annual paper should be coming out in a couple weeks here with our 12/31 capital market assumptions. We take each of your plan's unique benefit payment streams received from your actuary to figure out what are, what are the liquidity needs of your portfolio to make sure that benefit payments are made on time. We also consider the future contributions into the plan too when looking at the liquidity needs. And finally, the third and very important part is your investment policy statement and your risk tolerance. Once we have all three of these, Craig, Chris, and David have gone through a bunch of iterations of optimizations for you, looking at dozens of different optimization results, resulting in hundreds of different portfolios to see which are the portfolios that make most sense for you at this point, given the capital market assumptions and the constraints. As David said, we're in a new economic regime with the much higher interest rates, with the Fed increasing their federal funds rate by over 500 basis points in a very short period of time, really changed the landscape of potential expected return opportunities. And so now fixed income is a much more attractive option. In fact, given the assumptions that we're using, fixed income has an expected return very close to that of some of the lower discount rate plans. And so you'll see a concerted effort to show you portfolios with less risk and higher allocations to fixed income as a result of this optimization. Today we're going to show you key pension metrics with these portfolios that the team selected. We're going to look at contribution volatility, funded ratio volatility, and the impact that we'll have on the plans. On the right-hand side, there's a lot of words, but I just want to highlight the last point on the bottom. As we think about strategic asset allocation, this will not be a guide to outperforming in every market environment. However, over longer periods of time, it has been proven that it provides a roadmap for success over multiple market cycles. So moving to the next slide. One more slide forward, 2 more slides. In this next section, actually, I'm going to have you jump to which slide is it?
33, I think, with all of them.
33. Thank you, Craig. I could show you a bunch of, yes, thank you. I'm going to show you what the plan statuses were as of June 30th, 2023. You may ask me why of June 30th. This is your measurement date for your actuarial valuations. The first 3 plans shown are the pension plans. The second 3 plans shown are the insurance plans. But let's first talk about the pension plans. 3 pension plans, non-hazardous, hazardous in the state police retirement system. Non-hazardous is the biggest with a liability of nearly $16 billion and a market value of assets of $3.5 billion, resulting in an unfunded status of about $12.3 billion, or a funded ratio, which I'll talk about a lot, which is just the assets divided by the liabilities of 22.2%, using a discount rate of 5.25%. Non-hazardous plan, hazardous plan is much smaller than the non-hazardous plan. Liabilities of about $1.3 billion, assets of nearly $900 million, resulting in a funded ratio of 68%. This plan uses a discount rate of 6.25%, so 100 basis points higher than the non-hazardous plan. And then finally, the SPRS plan, liabilities just over $1 billion, assets just under $600 million, resulting in a funded ratio of 56% and a discount rate of 5.25%. Switching over to the right-hand side, looking at the same plans, but just in the insurance area, these plans are much better funded, with the non-hazardous insurance plan being 84.4% funded and a liability of $1.7 billion with assets of about $1.5 billion. The hazardous insurance plan, well overfunded at 181%, liabilities of $340 million, assets of $616 million. And then finally, the insurance plan, overfunded with a liability of $230 million and a market value of assets of about $245 million. These plans all use a discount rate of 6.5%. So much different between the pension and the insurance plans. I'm actually going to have us jump back to slide 16 here, just to show what the cash flows are for the various plans. This is a cash flow projection for the non-hazardous pension plan. The dark blue lines are what the expected contributions are from your actuary. The light blue lines, so contributions you can think of as inflows. The light blue lines are benefit payments, which are outflows. What you see for this non-hazardous pension plan is that the dark blue and the light blue lines are very similar in height, so contributions are very close to benefit payments. And this is really critical given the funded ratio of the plan at 22%. We really need those contributions to come in to be able to fund the benefit payments so the assets that we have invested can grow at their expected rate of return and higher to help increase the funded ratio. If we move 3 slides forward, please, to slide 19. Same type of graph, same color scheme, but this is for the hazardous pension plan. Here we can see that contributions, again, while significant, not as significant as the non-hazardous plans. These represent about 2/3 of the expected benefit payments. So very vital to ensure the health of the ongoing plan, but not as critical in terms of the level of contributions relative to the benefit payments. And finally, the third pension plan, which is 3 slides forward, which I believe will be slide 22. The SPRS, very similar to the non-hazardous, contributions are about 60% of expected benefit payments per year. So still very important to have those contributions come in, but again, not as vitally as important as that of the non-hazardous plan. If we want to jump to slide 25, please. Here we're looking at the non-hazardous insurance plan. Here we can see contributions are very low relative to benefit payments, and this is due to the much higher funded status of this plan versus the pension plan. So instead of using contributions to help fund benefit payments, instead, what would happen is you would have to sell existing invested assets to make the benefit payments. So this is important when we think about the liquidity needs of the various plans. So the liquidity needs of the pension plans can be thought of as lower because of the higher level of contributions, as long as we're confident that those contributions will be made when they're due in the future, versus these insurance plans, which have much higher benefit payments relative to contributions. In fact, the contributions for the other 2 insurance plans are both 0 relative to the benefit payments. So you're basically selling assets to make any benefit payments for these plans. That covers my introductory section. I think Craig or Chris will take over now to talk about the assumptions.
Yeah, thanks, Ned. If we go to slide 33, we can touch on the capital market assumptions that when we kicked off this conversation with Pruitt and Steve and the rest of staff, it was kind of late spring of last year, and we ended up using our June 2020.
Chris, I'm sorry, that's slide 34 in the board book. Yeah, thanks, Sherry.
I apologize. We ended up using the June 2023 assumptions when we started this project off. And you can kind of see coming down here, when we look at that first column of expected returns, you can see all of the different returns for the different asset classes. And these are bucketed by the way that KPPA tends to report all of their investments, which is equity, fixed income, and then inflation sensitive or inflation protection assets. So back in June of 2023, we were looking at a public equity assumption over the next 10 years of about 6.15%. You can see private equity was up just above 9%. And to the comments that have been made by Steve, Pruitt, and David a little bit earlier, our core fixed income assumption was actually just under 5%, which if we looked back to when we did this last capital market study, or the asset liability study back in the end of 2000, that core fixed income assumption at the time we did the study was now at 1.25%. So really nice to see that fixed income and all of the different yield asset classes are now providing a return expectation that actually can serve as a return contributor, but it also can act as a ballast within the portfolio, so that if there is a drawdown, core fixed income can really serve that purpose that we think of as being defensive in nature and still providing you the offset to the drawdown. Specialty credit, which is a mix of direct lending and high yield, almost at 7.5%, and you can see cash at just under 4%, with real estate and real return between 6 and 7%, respectively there. Wilshire also produces 30-year assumptions. And what we're doing here is we're looking at long-term averages across these asset classes, and it gives you an idea of where our current capital market assumptions sit relative to their long-term averages. So you can see that, for example, public equity at 6.15 over 10 years is about 100 basis points less than the expected 30-year return of 7.15. So when we go through and we start to look at these portfolios, we not only produce an expected return over 10 years, but we also give you an expected return over 30 years as well, given that this decision is really meant to be long-term in nature. You can see the risk numbers in the next column over, and then the cash yield numbers. Those go into the optimization. The risk plays a big part because as you think of an efficient frontier, you're really making a decision between a trade-off of return and risk. So as you move out the efficient frontier, we're starting to take more risk to essentially earn a higher return in portfolios. David talked about the factor exposures. We look at growth and inflation as our two factor metrics. You can see for each asset class, we have an assigned score, which is basically a regression against these asset classes against these factors. So as you would expect, our equity markets, they're going to be highly tied to growth. As growth markets are moving, if we're in a high growth environment, though we would expect those two asset classes to perform very well. Whereas if you look at inflation, if we're in an inflationary environment, those would obviously expect to be hurried or retractive of equity markets. And then moving over to the final two columns, when we look at liquidity within a portfolio, we want to make sure that we're building portfolios that are going to provide you with adequate liquidity to meet your benefit payments. So Wilshire has developed a liquidity metric that looks at what we call kind of normal market level liquidity. How much of the portfolio could be liquidated should there be a need to? But really the one that we want to focus on here a little bit more is that stressed metric, because if we do enter a period where we have drawdown in equity markets, we don't necessarily want to be selling a depressed asset during that drawdown period. So in a stressed market, you can see those equity metrics go down to zero. Where you're really going to find the liquidity during those stress markets is more within your core fixed income or your cash portfolio. The goal of having these factor and liquidity metrics in here is really on the factor exposure to help us build more economically efficient portfolios, and on the liquidity side to make sure that we're providing you access to portfolios that are going to be able to meet your liquidity needs in both market level stress and stressed metric scenarios. If we move to the next slide, this is the same information. However, Wilshire tends to look at asset classes in a slightly different lens, which we'll touch on here in a little bit. But we tend to look at things in what we would call a growth scenario. Growth would be public equity and private equity. Specialty credit, which is, again, is your direct lending and your high yield. While those are technically tied to fixed income, the specialty credit falls into what we call a defensive growth sleeve. So while they will provide you more of a defensive sleeve in normal market conditions, when you do go into drawdown markets, so take high yield, for example, it tends to act more like an equity component. So it tends to be more growth oriented in those drawdown markets. So that specialty credit we outline as a defensive growth bucket. And then when we get into defensive, that's where you're really looking at your core fixed income and cash. And then real estate and return would be under those inflation protection buckets that we look at. But all of the same numbers here, just bucketed in a different way. And as we go through some of the portfolios, we will continue to kind of show both the KPPA way of looking at the world in the equity, fixed income, and inflation protected versus Wilshire's growth, defensive growth, liquidity or defensive, and then our inflation protection as well. With that, I will turn it over to Craig to talk about some of the plans and the asset allocation that we've gone through.
Great, thanks, Chris. And I'll start off on page 37 and to go all the way back to Pruitt's opening comments, and it's been echoed several times. The investment landscape is significantly different now than the last time we did this. So you can see the current target, and I'm starting here with the plans targeting the 5.25% rate of return. As Pruitt mentioned, it was a struggle just to get to 5.25 or 6.25 in the forward-looking assumptions a few years ago. And what's happened since then is with these higher fixed income yields, the entire frontier has shifted up. So you can see here the current target, which used to be on the frontier, now falls short. So as has been said by several people already, there's opportunities to achieve that same level of return, which is on the vertical axis here. If you follow that current target to the left, you can cut your risk and still achieve that same level of return, which is really the goal of this whole exercise. And as David mentioned, there's several portfolios that have been identified that do just that. And it's just a matter of what level of risk this group is comfortable with to decide which one is the optimal way forward. But all of them achieve the same objective, which is keep a level of return that exceeds the discount rate, but at lower risk levels. So I'll jump forward now. As Chris mentioned, we have some of these upcoming slides bucketed in two different ways. I'll jump forward to page 40. Pages 38 and 39 are using the KPPA bucketing, and page 40 shows the Wilshire bucketing, which breaks out specialty credit as a defensive growth asset, sitting there between growth and fixed income, equity and fixed income, as you'd call it on the KPPA side. And I'll start by pointing out the constraints here. So as Steve said, if you just tell an optimizer, here's our assumptions for these different asset classes, what's the most efficient portfolio, it will tend to swing wildly based on what the assumptions are, because there's no input for the friction that goes along with trading those portfolios, whether that's the transaction costs or in some asset classes, just the fact that you cannot quickly enter or exit these positions. Think of, private equity. So part of what the constraints do is rein in that modeling to reflect reality. So for example, we already have a relatively low public equity level of 32.5% in the current targets. If we let the model trade that all the way down to 20, will we be back here in a year or 18 months, bringing that back up to 30, 35? We want to dampen some of the swings that we would get. And again, the goal overall here and what we think we can achieve today is to move towards something that's more efficient, lower risk, similar return. We don't need to trade the whole portfolio to achieve that and incur costs that then eat away at that forward return. So the main themes that we see here is growth assets, which is public and private equity, starting at 39.5% total, slowly shifting down as we move from portfolio X to Y to Z, stepwise moving down by 3% each time. Specialty credit in X and Y slightly increasing, and in portfolio Z being maintained the same at the same level of 15%. And then on the defensive / rate sensitive assets, stepping up that fixed income allocation. Now that fixed income is providing utility again compared to where it was a few years ago, we can improve the portfolio return to risk ratio by doing this and take risk out of the portfolio. And then the real assets or inflation sensitive assets are coming down slightly in these scenarios. Part of that is because of the challenges facing real estate currently, and part of that is because there's some growth exposure in these assets. So one of the ways we can reduce the growth exposure of the portfolio is actually to allow these real estate and real return assets to come down somewhat. And there's a chart coming up in a few pages, which I think is a lot more useful when thinking about the growth and inflation scoring than just looking at numbers in a table. So we'll get to that and discuss more in a minute. Another thing you'll notice here is that the percentage of the portfolio that's in illiquid asset classes is also coming down as we step forward here. So not only taking volatility risk out, removing some illiquidity risk. And then, like I said, the efficiency of the portfolio is able to improve now that fixed income provides more utility. And that's in the bottom line there. We see the current Sharpe ratio of 0.29. We can improve that to 0.3 or 0.31 in these other portfolios. So the Sharpe ratio being a risk-adjusted measure, it's your return less the risk-free rate, then divided by the standard deviation. So we'll see this in a chart in a page or two, but portfolio lower risk X maintains the current expected return over 10 years, but does so with roughly 70 basis points lower risk. And then we continued to step down the risk spectrum with portfolios Y and Z. They are stepping down risk by 130 and 240 basis points. And with those portfolios, you do have a slight reduction in the expected return, namely 20 and 60 basis points over 10 years. But again, more efficient on a return to risk basis. And given the discount rate of 5.25, all of these plans exceed that threshold. So if we step forward to the next page, 41, want to point out here that one of the reasons we like to try to reduce growth exposure is because the growth aspect of the portfolio usually drives volatility as well. So we see here on the top line the percentage of growth assets coming down. About midway through the page, we have contribution to volatility. And you can see that even at your current targets, about 40% of the portfolio being growth assets is responsible for about 70% of the risk. So these growth assets come with a higher level of volatility. And if we can decrease that volatility and reliance on growth, the portfolio becomes more well-rounded. On the bottom of the page, we see the liquidity metrics that Chris had talked about improving with each of these steps down the efficient frontier from X to Y to Z. And no surprise, the main move in these portfolios is adding more core fixed income, which has a higher liquidity score in the market and stressed environments. And then I'll get back to the growth and inflation in a few pages. Note here that the yield also improves, again, a function of increasing the core fixed income in the portfolio from just under 4% to close to 4.5% in each of these three alternative options. And if we step forward to page 42, to come back to the efficient frontier, this is zoomed in a bit more to focus on where we are and where we're potentially moving. You can see lower risk X, as I mentioned, is that exact same expected return. So you're moving straight left on the reducing risk to find where you can create an efficient portfolio given the assumptions and the constraints. So portfolio lower risk option X maintains your expected return and cuts risk, and then Y and Z allow you to further reduce risk. But as you can see, you're coming back down that X-axis or Y-axis. So you're reducing your expected return at the same time. But again, all three offer lower risk, return in excess of your discount rate, a better Sharpe ratio, so your risk-adjusted returns are improved on a forward-looking basis.
Hey, Craig, I'm just going to jump in and add a comment, as you were mentioning on the previous page about exposure to growth, sort of economic growth environments. It's an interesting thing. We don't take this lightly. We've studied a lot of plan allocations, particularly in that paper that we put together every year when we look at the asset allocation of roughly 100 or so retirement systems around the country. Most plans, based on how they're allocated, or I should say a large majority of plans, are highly tied to one economic factor, and that is, if we have an environment where growth is rising, they'll do okay. And, you know, in recent years when we've studied this, we've found that somewhere around 88 to 90% is how much many plans are relying on one outcome. And so that's the important part about this. We've been focused on this since over a decade now, since after around 2009-10, as we spent a lot of time looking at, you know, why did everyone miss sort of their expectations when we had the credit crisis and the sell-off in asset values back then. And we've spent a lot of time on that. We've written research on that. And that's what leads to these factor exposures we talk about, growth and inflation, and just trying to have some balance in return. So what I would say, if we just go back one page just for a minute, and you look at when Craig was going over those contribution to asset volatility numbers. If you combine growth and defensive growth, you're looking at, around 80%, say, even for your current target. And then you move out to the right, you see some differences in those. But, relative to a lot of plans, that's good because you are already more diversified and a bit more reliant on other economic outcomes in terms of what's driving your risk and therefore what's driving your returns. So that's just we believe this is a really important thing, and a lot of systems, a lot of plans don't really focus too much on this. So I just wanted to highlight that.
Yeah, David, I would completely agree and echo that, and we were in an environment where, as I think Craig and Chris mentioned too, that a lot of plans were forced into reaching for growth, right? I mean, in order to achieve those higher assumed rates of returns that a lot of plans wanted to maintain for an extended period, and it's still maintained to some extent, they were forced into growth assets. And I think that's really an important point here is that, the current environment offers us an opportunity to diversify away from such reliance on growth. And I think that's, I think it's an excellent opportunity for the health of the systems.
And Steve, even to put a finer point on that, when we did our asset allocation study back in 2000, to Pruitt's comment early, we had to reach to get to 5.25. So when you look at where the efficient frontier was back then, we were very far right on the efficient frontier to get to that 5.25 plan. So don't think about this as necessarily de-risking. While it is de-risking, this is almost an opportunity to get back to those portfolios that were more economically diversified or economically optimized prior to being in such a low yield environment.
Let me just add one thing kind of in a global picture of things, and Mr. Eager can correct me because I always overstate this, I'm sure, but in general, we can't earn our way out of the hole we're in. We can earn our way into a deeper hole, lack of earnings. But what has enabled us to improve our funding ratios significantly is decent earnings and above average. But more importantly, the confidence of the legislature to fully fund these systems. Now, some people would say it's out of fear that they're doing it. I don't believe that. I think it was intelligent analysis by the PPOB board, and that realized we needed to do this in our budgeting. And but the point I'm making is that we don't want to do anything and the downside, create downside problems in our returns that loses the confidence of the legislative group. And so that's why we just can't, in our opinion, go too far out the growth and volatility continuum. And I'm gonna give you Kentucky's got a yin and yang. You look at the legislative and judicial system, it's, I believe, about 100% funded, and it's 80% stocks, and they can do it. They don't have to worry about the downside unless it's really bad. They will find worry there. But and then the other side is our system where we were, but we're a lot better now. But so just the big picture of what risk could mean for us. And Dave, if you got any comments to add to that, please jump on.
Dave had to jump off this call for a few minutes, but he would agree with that. Both budget bills are out now. The legislator's budget bill hit yesterday. Both budget bills have extra money over and above the actuarially determined contribution rates. So I think we've seen several years in a row the legislatures are committed to funding the systems appropriately.
And we certainly don't want to do anything to change that.
Yeah, Pruitt, I couldn't agree more. The legislature's commitment has made all the difference. And if we just look at the 15-year time horizon from the Great Recession through a pandemic, through this post-pandemic period in which recession was predicted, and who really knows if it's a soft landing. But if Steve had to tell us one more time about volatility, and we all know it. And right now we could put the whole damn thing into a CD at 5% and know we're going to get 5%. That's a pretty good low risk return. We don't know what interest rates are going to do, and Lord knows the market doesn't know what interest rates are going to do. But we have to assume that much of the predictions about interest rates have already been factored into the market. But I couldn't agree more, Pruitt. This is a time where, for me, the greatest hedge against volatility is prudence and some consistency where this sea change in interest rates and fixed income makes diversification really meaningful, and we can hedge that risk. I think we get in trouble anytime we look at the unfunded liability and think, well, if we could just be smart enough to shoot for the fences, we got to bet it all on red. We don't have to do that, and it all comes back to haunt us, particularly when the legislature looks to us to be good stewards of some very difficult political decisions they've had to make. So everything I've heard from Steve and David today and the others very much comports with my own sense of how we should proceed. So I'm very encouraged by what we've seen. And Pruitt, your expertise is just very reassuring as well. So.
Well, Steve, do you think we're at the point where we can unveil the door, open the door of which we've sort of chosen to go with, and then maybe to come up with a motion on that?
Sure. I just want to check with Wilshire if there's any additional, you guys have covered a lot of material here. Anything you want to lay out or present before making a recommendation on the portfolios? I think, we also want to have a discussion. I think that's, I appreciate the comments. I think we're looking at this the same way, and I think it's not just prudent, but it's the right thing for us to do to take advantage of the opportunity. I mean, that's what we're supposed to be doing on a day-to-day basis. This is what we're supposed to be doing, is taking advantage of these opportunities. And it just makes, to me, complete sense that we take an opportunity like this to de-risk. And we look risk as David, as Chris and Craig have talked about, we look at risk in a number of different lenses and spectrums. And this really does a good job on a number of fronts. We're de-risking from expected risk, from where our reliance is on generating returns in the portfolio. That's how we look to construct portfolios. And I think this goes a long way to putting all of the systems, in what I feel is a much better place going forward. And the durability, I talk about durability of portfolios, and sometimes it's a bit of a misnomer, but, looking at how we could construct these portfolios with these asset allocations, it puts us, we can never sleep comfortably at night, but it sure makes it, a lot better position to be in, from my point of view. So.
Yeah, Steve, I would say maybe a couple more pages. We've gone through the X, Y, and Z on the 525 side. So
Okay.
If we can start with page 43, just because I teed it up a couple of times, so I'd hate to not actually hit on it. So this is our chart of the growth and inflation factor scores we talked about before. I think the chart does a lot better job of driving the point home than the numbers in the table did. So the ideal situation would be if that cash dot, the size of the dot represents the expected return. If that cash dot was big enough to meet your targets, you would just go there. And then, if growth is higher or lower, it doesn't really affect you. You're on the 0 point for growth. If inflation runs hot or cold, it doesn't really affect you. You're insulated from those factors. The portfolios need to shift out to the right here and take this growth risk, because you can see the bigger dots are out there. So, if we go back a few years, we had to reach out towards these public and private equity dark blue dots because they were the big dots on the page. Core fixed income and cash were minuscule little, about as small as we could make them in this chart and still have them be legible. So now that this, core fixed income and cash, the size of those dots has grown, we can pull back on this growth risk. And you can see in this cluster in the middle, you've got the brighter red is where you are today, current target, and then these next three, which are kind of all covering each other, continue to take that growth exposure down and have pretty similar sizes to them, meaning the expected return is pretty similar. That's the trend we want to take advantage of here, and it's been echoed several times now. We can cut this volatility, but also growth exposure. That ends up with a portfolio that's closer to this center point you can think of as relatively insulated from growth shifting higher or lower, inflation shifting higher or lower. And I think the other page, Chris was going to go through the modeling we did on the plans with the higher discount rate, 6.25 or 6.5 for the insurance. A lot of that is kind of repeat of the comments I made on the 525 plans, but Chris, I didn't know if you wanted to just hit on page 50 or something else.
Sure. Happy to do so. And maybe if we just go to, I think it's slide 45, which is the efficient frontier for the 6.25 plans, or maybe it's down one from that. Down just a little bit, 47. There you go.
47, yeah.
So you can see here on the 6.25 plans, just to kind of reiterate what we were talking about a little bit earlier, when we look at the current target, how far out the efficient frontier we are. And that's, again, we're just kind of going through hammering, kind of the dead horse here a little bit probably, but you do have the ability to move back to have a more economic, diversified portfolio with less risk to obtain the same return target, or you can even bring risk down a little bit further depending upon what your risk tolerances are. And as we go through and we present these alternative portfolios, that's really the decision that's going to be put to you right now is, what is your risk tolerance? How much risk do you want to take? At what return level are you comfortable with positioning these portfolios for the next 3 to 5 years, or the next time we do an ALS for you? If we go to the next page, you can see here a little bit different current composition for these portfolios, given they weren't as the funded ratio was much higher for these compared to the 5.25 plan. You can see here that we do have a little bit over 40% in current public equity with 10% private equity, a little bit less fixed income, similar inflation protection. But when you look at lower risk A and B, the way we're going about providing these options for a decision today, we are taking a little bit of public equity exposure off the table, adding a little bit more core fixed income in the case of lower risk B. You can see that specialty credit is really what's moving the needle. Specialty credit or private credit or direct lending, and high yield is where a lot of the opportunity is from a return to risk trade-off. But you can see when we go down to the expected return of these portfolios to get at a 6.99% expected return, which is even higher, a little bit higher than your current portfolio, just by a couple basis points, you're still able to take off almost 100 basis points of risk there. So that's a significant risk trade down right there. And then if you wanted to move even a little bit further down the risk spectrum, take off about 125 basis points of risk, you can actually move a little bit further into that core fixed income. You don't sacrifice much on the return. It comes down to 6.86 as compared to 6.97, but you are going to get about 125 basis points of risk reduction from your current portfolio.
Hey, Chris. And we're trying certainly, Pruitt and Steve, not to belabor this too much. So I just want to jump, if we could, to one more slide. Ned, if we could go to out to 58. And I say this because the whole second half of this is all about the liabilities, and you made some really good points, Pruitt and David and Steve, about funded ratio, and when the legislation comes into all of this and contributions come in, et cetera. And so I think, there are a whole lot of these charts, but if you just pick slide 58, which is the K non-hazardous plan, and look at everything we've seen so far has been asset only sort of data, but this brings the liabilities in, and this shows with simulations what it looks like, say 5 and 10 years out. at the funded ratio, which is, one of the key things that legislators and others are paying attention to. So Ned, could you maybe just spend a minute on this slide for us?
Yeah, great. Thanks, David. So I'm going to ask you to ignore the numbers on the left-hand side of this graph and just focus on kind of the progression of the colors of the red dots. And before I dive too deeply into this, just let me explain what we're showing here. So in our simulations, we run 5,000 different economic trials in every year. So over this 10-year projection period, there's 5,000 trials in each year. And so just focusing on the far right-hand side, that red dot represents the 50th percentile or the expected result. So what is the exact middle of those 5,000 economic trials? The top of the solid color line, that represents what we're calling an optimistic result or a 75th percentile result. So 1 in every 4 scenarios is better than that top of the solid color line. And then the very top of the thin black line is the very optimistic or 95th percentile result. So 1 in every 20 results is better than that top bar. But, and the bottom is the 25th percentile and the 5th percentile of the solid color and the lines respectively. So, what we see, and this is the non-hazardous pension plan, is the contributions going into the plan, which are essentially equivalent to the benefit payments going out, as we saw on a previous slide. By not having to spend the corpus of the assets, what we're seeing is that given the reduction in risk that Craig and Chris went through with the alternative portfolios being in light blue, red, and green, we maintain the expectation of the current portfolio, but we dramatically shrink the distribution or the potential variance of the funded ratio results. And if you look at the more pessimistic results, you see that the pessimistic results are actually better than that of the current portfolio by moving to a lower risk portfolio, which we've talked about extensively during the course of this meeting.
Thanks.
David, is there anything else you want to add?
I think that's good. That's just, takes one of the plans and just shows how that, how the focus is when you bring liabilities in. So, yep, I think that covers it well. Back to you.
Well, thank you all of you from Wilshire for as always. It's a complicated question. You do a good job of putting it in our language we can understand, and I think it's pretty clear we have an opportunity here, and with the capital markets have given us an opportunity and to for no cost. I hate to use that term, to reduce our risk. So, Steve, do you want to talk about the 3 alternatives and which one that you would like for us to explore and vote on?
Absolutely. If we can, I think page 40. Jumping around a little bit. Okay, so for the 5 1/4 plans, these are the 3 portfolios we kind of focused in on, and I think the recommendation that we would make is to adopt the asset allocation of what is called here the lower risk X portfolio, which maintains, as we've talked about it, it maintains a similar level of expected return. It lowers expected risk volatility. It increases the Sharpe ratio. It maintains or slightly improves the liquidity profile of the portfolio, and it reduces reliance on growth, as we've talked about. So I think that would be our recommendation. Happy for discussion on that one if we want to take them one at a time, or if we want to do the next plans, we can do that in concert.
Any comments or questions that board members have? Steve, you want to move on to the other?
Sure. I think that's page 48. Sorry, Sherry, making you jump around here. Again, for the 6 1/4 and 6 1/2 assumed rate of return plans, these are the 2 portfolios that we focused on. And again, I think for our recommendation, we would recommend to adopt what is here the lower risk portfolio A. similar rationale is with the 5.25 plans, similar results and optimizations, reduction in risk, reduction in reliance on growth, achieving similar level of return for a lower risk portfolio, maintaining liquidity.
And in terms of risk, if you go down to some of our favorite numbers, the standard deviation of return, that's 12.1 is where we are, 11.29, that's just de minimis. That's not almost unmeasurable in the same way with a Sharpe ratio. So essentially we're holding a risk at a slightly lower level, but certainly not increasing it in this alternative.
Yeah, I mean, we're achieving almost 100 basis points of expected risk reduction in the portfolios, which is pretty meaningful, and able to do that at a similar expected return. Again, increasing Sharpe ratio, slightly improving liquidity, and also reducing the reliance on the growth factor that we've discussed. So those would be the recommendations.
So Steve, in this particular scenario, and I realize the difference in the standard deviation return between 83 and 124 isn't much, but to reduce the risk that much more in risk B scenario for what looks like a cost of 13
basis points.
Tell me a little bit why the scale tips in favor of risk A.
Well, I think in risk A, our view on where we're achieving, you're right. I mean, I think again, we always take grain of salt with the expected returns. It is a pretty significant, so you get a 40 basis point reduction in risk relative at a cost of 13 basis points. One of the considerations there, especially with the move to the 6.5. From 6.25 to 6.5 assumed rate of returns for the insurance plans, which this is they're included in this modeling, is what's your comfort level with distance relative to that? That 13 basis points is noise, as Pruitt will say. It's a bit of a rounding error, but do we have a degree or a level of comfort with achieving the probability of achieving that assumed rate of return and over the longer period of time, and where is our comfort level with lowering the probability of achieving that and the possibility of not realizing that assumed rate of return? I think that's a great discussion point here. This is not I think our view internally was, given where the shift is in the allocations, our view on asset classes. Obviously, we view currently, as we've discussed many times, that specialty credit asset class as in the current environment offering one of the most attractive risk return profiles, especially how we tend to invest it up the capital structure, more secured asset coverage. We're really comfortable, constructive on it. It's a bit of splitting hairs here. You can certainly, as we have done, made the case for either one of these portfolios. I think in my view, it comes down to that degree of comfort with the distance from where the assumed rates of return are relative to the expected returns of the portfolios. At a 6.25, if we were straight 6.25, would we probably maybe lean towards portfolio B a little bit more? That's quite possible. I like to have, at least on an expected basis, a little bit more degree of comfort there. And again, it's only 13 basis points, and it cost us 40 basis points of expected risk. But that's a little nuanced. I think we could certainly make the case for either one, as we've done here, as we've presented.
So Steve, do you think that comes down to the choice between the 20 or 25% in specialty credit?
That's the biggest. Yes, that's the biggest difference. If you notice, it's shifted between core and specialty credit, right? So that's that 5%, 500 basis points difference in allocation is really shifted between one of those, and that's the biggest driver between the difference in both the expected risk as well as the expected performance. So I think if we want to open that discussion up, if people would make the case for either, obviously we put these in front of you. We will make a recommendation for the lower risk A, but I think we wouldn't have put lower risk B in front of you and opened it up for discussion if if it wasn't something that we thought would be an efficient and a good portfolio.
We have a couple of questions. Ramsey, I think you were first.
Thank you. Yeah, just the gray column, the optimization constraints. Talk a little bit about that. I'm referring specifically to the specialty credit because it's not within. It's the only one that's not within.
Yeah,
Sure.
Go ahead.
Yeah.
Go ahead.
Yeah, so there were various versions of this. So on the final frontier that we ran, we had brought that constraint down to 20, but we had run one before that allowed 25. So lower risk A does technically fall outside the final constraints that were used, but because we went through so many iterations of this, we were really splitting hairs between where some of these constraints were set. That we essentially kept lower risk A as an option, even as we ran one more iteration of the frontier. Essentially, it's as Steve said, you have to take this forward-looking work with a grain of salt, and we don't expect to have a crystal ball on any of these. There's a degree of uncertainty surrounding everything that we thought it was okay to continue to model that portfolio with the constraint having come in to 20%. And again, here we didn't spend much time on this page. The process was pretty similar here to what was done on the 525 plans, but with these plans, obviously a higher starting point for public equity. So that public equity floor is set a bit higher as well. And then something that wasn't mentioned on either of these, you'll notice that the cash range is set to 2 to 5%, whereas the current portfolio only has 1.5. That was to allow a bit more cash to sit in the policy and not be a drag against returns, and really reflect a level that was better suited to the staff's need to manage cash flows. So wanted to point that out as well, that the floor we set on cash is to make sure that's part of the benchmark and not counted against staff when they're holding a couple percent of cash to manage the operations.
Yeah, and I think one of the things you'll note, especially with this, is the modeling is so different, obviously, than the last time we did it, and you'll notice we bump up against constraints, and that was lots of the discussion and evolution of the process that we had here was, given the divergence that we have across asset classes, you'll see if we didn't have a public equity, so public equity almost always on all of the efficient modeling was going to be at the lowest end. Whatever the constraint was, that's where it was going to, again, if we talked about if we didn't have a lower bound to public equities, a lot of efficient portfolios would have zero public equities, right? We didn't want that. And so you'll notice on the specialty credit, that one, if you didn't have an upper bound, the model tended to put a lot of the portfolio into specialty credit, upwards of, I don't know, correct me. I think some of the constraints we were 50+% in specialty credit. And that just tends to be the efficiency of that asset class in the current modeling.
Yeah, the modeling would essentially build you a mix of credit and core fixed income to get to the return you wanted and say, leave all the other stuff out. Just, again, that's one of the perils of letting this run unconstrained, right? It doesn't reflect the economic reality that, you can't turn around your real estate and private equity investments overnight. There's transaction costs, even in public markets. You would not necessarily have a good balance of growth and inflation factor scores. So yeah, all in all, the optimizations were an iterative process that we probably changed a good 8 or 10 times as we worked from unconstrained to a final point that we thought was tight enough without being without essentially forcing the optimizer to not have any options.
And I do think one of the we've focused here on targets, right? If we think about our asset allocations in the IPS, we tend to have targets with ranges around there, and how we view the ranges is our ability to allow market conditions to move without forcing rebalancing or to be tactical. Again, these are long-term asset allocations, although we'll update them, more frequently than 10 years, obviously, or 30 years. But it's also, it affords us the opportunity to take advantage of market opportunities. So while we have a target of 25% for specialty credit, we might not be at target for a while. We might take our time in committing capital, or if we're at a 40% on public equity, we might be 42%. If we think that's, where the current opportunity exists, we might take it down to 38%. But these are kind of the targets, and that's what we focused on, but we also have ranges in the IPS around those targets.
Ramsey, does that handle your
Yep.
question?
That answers it. Thank you so much.
And I think it's important that these are not going to be the target ranges necessarily. So, John, you have a question? Up, you're mute. Did we lose John?
I don't think his microphone is working.
It shows microphone is muted on John.
When he's unmuted, it's not hearing him either, though. So I don't think his mic is.
I think he's experiencing some difficulty.
Looks like he's calling in.
We will wait on his question.
Pruitt, while we're waiting, one of the questions I had for Steve was, so what, once we make the decision, what is the time frame that we should realistically expect, given what our current cash position is, and future decisions about potential commitment of some of that cash, and the likelihood that there may be additional contributions from the legislature. But as we try to organize all of that, what is the trajectory to get to the asset allocation that would be ultimately approved? Is there a difference in our choices here? One that would take longer to get there than others? And should we care about that?
I think there is a continuum of, yes, you should care if you're implementing a asset allocation that is going to take 5 years to implement. That's meaningful. If we look specifically here, I mean, we can look at A and B, or we can look at X, Y, Z, I believe, or the other ones. But for the most part, the ability to implement relative to where we currently are within our asset allocations, we are not. These would be much quicker. We've made progress. And as we'll see when we have the 12/31 asset allocations on my graphs, there's a lot less red than we had. We've made a lot of progress, especially on the real return and real estate, which were the two that were most out of line or outside of range. We've made a lot of progress in deploying capital there. I would expect to be able to ramp up, given the asset classes we're talking about, and we're not talking drastic shifts in asset classes that are more difficult to allocate to or to change allocations. I would think we could implement fully within a couple of quarters. I would think the biggest thing would be especially if we were to adopt the 25% specialty credit. I think that would necessitate having sourcing additional investment managers to fill that, which that process takes time, but deploying that capital tends to be certainly a lot quicker than what we've seen in some of the real return asset classes.
So Steve, in order to make the adjustments, is there a cost by selling something off that might be right now projected to have a growth factor that would be moving into an asset class that wouldn't necessarily, I guess I'm just looking for what is the opportunity cost of making the shift? Are we selling an asset? Would we be required to sell an asset that we would be smarter to hold on to for maybe a shorter period of time, a longer period of time?
We would certainly make that determination on an investment by investment basis, whether or not it was warranted to continue to hold. Again, the shift here is in fairly liquid asset classes, or at least the more liquid asset classes. So we're talking minimal transaction costs, but we're not talking much in the way of opportunity cost. And, it's not, as we've seen, I think we've been prudent in that decision-making and shifting. We have not, changed asset allocation at all cost, regardless of what it would cost. We've been prudent in doing that. We've shifted allocation where we can, taking cash flows, taking distributions and reallocating those as opposed to, kind of doing a wholesale sale of a security. So that's part of what I would think it would take some time. Again, given the shifts that we're looking at, it's a matter of quarters and not 4 or 5 quarters.
I appreciate that.
Sure.
Sounds like we've got John back, Mr. Chair.
Pruitt, I think you're muted.
Mute. Am I on now?
We can hear you.
John's question was, are there any changes to assume rate of return in pension or insurance plans? Actuarial rate of return.
That's not part of our discussion here. I think that's a board discussion that occurs. We take the assumed rate of return that is the board determines and look at that from a risk profile as to what the risk that the board is comfortable with, but those tend to be pretty independent. We obviously are cognizant of wanting to build portfolios that have a higher probability of achieving those assumed rates of return, but those tend to be, we like to have those as independent discussions. I don't think we necessarily want to take whatever that assumed rate is and build the portfolio specifically to achieve that assumed rate of return. Those tend to be independent decisions.
And that question is one that does involve the interest of a lot of stakeholders, from the finance cabinet to the legislators to everybody. And so that's not something that is done without consulting and getting the reaction of everybody involved, not just a pure actuarial number. So, but there is no real serious discussion that I'm aware of, but are we, I think we're getting to the point where we could put the two buckets, the two decisions up for a motion. I think we want to do them separately since there is a different nomenclature there. I'm hearing crickets. What I would like is someone to make a motion on we'll start with the plan, the 6.5 plan that's on the screen, page 47, with to adopt lower risk asset liability or asset mix.
Yeah, so Mr. Chair, I would move that we accept the recommendation of our investment advisor, our internal investment team, and adopt lower risk as our allocation going forward. And I guess Pruitt, this is a recommendation to the full board. Is that correct?
This does go to the board to be ratified. Yes.
It's to ratify. So it's not a recommendation that way. You make the decision and then they ratify it.
Oh, I see. So we're not asking. Yeah, I got you. So this is a motion to adopt lower risk as our allocation.
Correct.
And this is for the 6.5 plans. Do I have a second?
Second.
Second. Any further discussion?
And to clarify, it's the 6.5 and the 6.25.
6.5 and 6.25. I'm sorry. Yes, a mix. I don't, do we need a roll call or can we do this, Vicky, by acclamation?
You can do it by acclamation, and just for the record, Ms. Thompson had to drop off, but you still do have a quorum.
Okay, we still have a quorum and we have a recommendation and a second on adopting lower risk A. Any, do I hear all those in favor say aye?
I,
Aye. The motion is approved. And could we bring up the previous that had the X and Y and Z? I'd like to just
I believe it's page 40.
page 40, yeah. Okay, that one. Now these are for this is the recommendations for the 5.25% return plans. And I would like a motion to approve that labeled in the middle, lower risk X.
So moved, Mr. Chair.
Have the motion, Mr. Atkins, second.
second.
We have a second. All those in favor say aye.
Aye.
I,
Motion is approved. Thank you very much. This is always educational and important, and I appreciate everybody's great attention to it. So that takes care of that item on our agenda. We have a second item, which is I will preface a little bit. We have a manager recommended that'll fall under the real return recommendation. The real return is as Dave Atkins is, we've had this discussion back and forth. We don't, sometimes the labels here aren't exactly accurate, but we don't have better labels. What we really are looking for in these, to fill these buckets at real return, is non-correlated managers. In other words, a manager whose source of returns comes from not stocks, not pure fixed income instruments, just buying and for the yield on them, but comes from other sources that are just non-correlated. And we're not making a recommendation, but I'll give you an example of a non-correlated asset would be a commodity. But we're not recommending anything there. But what we are recommending is a very interesting manager, a fellow that's had many years of experience with a couple of large firms in New York. He happens to be, I think, the world champion poker player. Is that correct, Steve?
He's certainly a very good one. Yes.
Don't want to play poker with him, and but against him. Let's put it that way. So we have a recommendation, and I'll let Steve go through Steve and actually Anthony go through the details. It's a very interesting source of returns.
Apologies. Yeah, that's a great introduction for it. And I'll just a couple of minutes before I turn it over to Anthony. And that's exactly right. I think while the real return might be a little bit of a misnomer and it has some connotations, historical connotations to some asset classes that we weren't necessarily in favor of. I think we look at this as we have, and if we look at the investment opportunities that we've brought, and we appreciate that the IC and the board has approved, and we're in the process of funding. We're really looking at this allocation as an opportunity, as Pruitt mentioned, to look for investments with lower overall correlations to our traditional asset classes that we hold in abundance in other parts of the portfolio. But also, and probably more important in my opinion, is less correlated sources or drivers of performance. So how are they extracting performance from markets and having those less correlated to, as we talked about, I think, which was actually, it goes well here, as we look at growth, being a factor for so many of our investments, and kind of living or dying by that growth factor. We want to look in this allocation for investment opportunities that don't necessarily rely on that, and look for different sources or drivers of performance. Ideally something that has, asymmetric payoffs. It's a unique opportunity. And Anthony has done a tremendous job. We look at the three that we recently brought last year. as well as this and some other things that we're looking at. These are differentiated sources of return. These are not, off the shelf stuff that, every plan may be doing. I think we've been able to source some great opportunities. We're excited about this one. I think it's a great fit, and more importantly, an excellent complement both to the existing investments in that specific asset class allocation, but a complement to the broader portfolio. And again, it's all in the pursuit of lowering that overall risk, and some of that is lowering what's the driver of the performance here, but also at the same time doing it in a way that we think is going to be able to produce nice performance over time. So I think we're excited about it, and with that, I'll hand it off to Anthony.
Yeah, sure. Thanks, everybody. This is a manager that we've been looking at. We first met with about 4 years ago, one of the last conferences right before COVID. They've been around since 2009, but I think their background is in credit trading, relative value. But they over time have found different areas that are interesting across markets. So SPACs has been a recent one that has kind of dissipated in the past couple of years. Closed-end fund is something that they've done for the past 10 years or so. Closed-end funds are not exactly new investment. They're kind of predecessors of ETFs. They're primarily a retail investment product that is traded, but they're sold to investors, and usually it can consist of all kinds of things. So it could be things that are typically more alternative investments like municipal bonds, MLPs, just stocks in different sectors like biotech or just regular technology, all the way to private companies. There's a limited amount that they can do. And so what happens to them over time, though, is they tend to trade at discounts because the supply and demand dynamic is a little bit off. There isn't like a regular source of demand to buy these, but when people want to get out of them, when people want to get out of them, there isn't anyone to necessarily take the other side of that. So they trade at discounts, often in the single digits, but in different times of market dislocation or other other reasons, then they can widen out. Often they widen off with sell-offs, right, with credit spreads. One of the more interesting things about this opportunity is that they're near historically wide levels, even as credit spreads are not super wide. And so buying at a discount is always interesting for us in terms of value. One of the things that is different, though, here is the activism component of it, because things can be discounted and everyone can see the discount, but the discounts can remain for a long time because it's in the incentive of managers like a BlackRock, Nuveen, Franklin Templeton, any number of brand name investment firms to keep these assets as closed-end funds because the fees are higher. So basically, the main beneficiary of the status quo is the fund manager, while all the shareholders that are still in the funds, are sitting with a basket of assets that, it may be like there's one of them that would be their potential top holding for the account that we would do. It's just tech stocks. So it's just your Mag 7 is some of your top 5 holdings, and that trades at a 15% discount today. And so that doesn't really make a lot of sense, but that's just kind of the construct of the market. And the reason why that Saba is going to be the different approach they bring to this is the activism. They've been buying up large percentages of the shares and then being active as shareholders and advocating for everyone to have the manager close the discount, which they actually can, like literally instantaneously. Like if they just decide to merge it or liquidate it, the discount goes away. Some of the resolutions they have come to with different managers is either a tender offer or merging the fund. Goldman liquidated one last year in the MLP space. So what they're doing now, and why the timing is also interesting, besides the historically wide discounts, is that the annual meetings are coming up for a couple of the managers, and one of them is BlackRock, which they have been working against for several funds, and would be a significant portion of the account. And their annual meeting is in July. So managers like BlackRock and others have come up with ways to kind of suppress the vote for Saba. So they've had to litigate that and have won some victories in the past few weeks and months that could allow their votes to be counted. So right now, let's say they own 20% of XYZ fund. Well, you would think, one chair, one vote, like they would get to vote their 20%, and that would be a pretty significant chunk to get like a board seat or something like that. Well, the funds have made it so that not one fund, one vote counts. So like they might say, all right, we put in a restriction. So even if you own 20% of this fund, the most you can vote is 9.9%. Is that legal? Is that not? That's what the courts are deciding. Or they can say, fine, you own 20%, but if you're going to get what you want, you need a majority of all shares, not just the shares that voted, like in a normal election, like we would have at the polls in November, but like all shares outstanding. And it's not like most people are looking at their accounts and voting their, 10 shares or whatever. And so if you count all shares, then, their resolutions lose. And so as they've been winning in the courts, it seems more likely that they are going to be able to vote their shares in full weight and be able to influence the outcome of some of these funds. So that's another reason why this is of interest for us. And so we've talked with them about first about real returns, because many of the underlying securities in this area are MLPs, infrastructure, different industrial stocks that are in this area. But then we also over time, in general, we try not to constrain our managers. We'd rather have them express their best ideas and the things that they have the most conviction of. And a lot of the funds at the widest discounts today actually are muni funds for whatever reason. We wouldn't get any tax benefit from that, but it's just muni bonds, nothing super exciting, but California bonds or Pennsylvania bonds, New York, and they're just trading at 15% plus discounts. So being able to close those.
To Anthony's point, that changes over time. Obviously, as he's mentioning, it could be a certain sector of the closed fund market right now is trading at a wise discount, but over time that'll change, and it could be, the MLPs next year could be the asset class with more significant discounts. So we wanted them to be able to take advantage of that over time.
Right. Let's see here. If we look at page, it might be 130, 133. Can you go to that share if you don't mind? Yeah, so the orange graph here we borrowed from BlackRock, actually, in Morningstar. It shows that, over time, over 20 years, this was like kind of where are the discounts, where the discounts been the widest. And so over those 20 years, the discounts have been in the double digits for just muni bonds. This is among the 50 widest days over 20 years. And so that is just what that chart's trying to illustrate is that, this is an unusual time. So that's kind of where that is. And if you go to the next page, closed-end funds, it's a pretty, the decomposition is pretty simple, right? The net asset value of these bonds, like if you have a basket of just bonds, it's, you're going to get the return from those. So we still have exposure to that in this investment, and you get the income from it. Obviously, there's fees and expenses as a retail product, it's a bit higher than we would normally have. And then the discount changes. And obviously, in the top part is what Saba is going for. They are trying to actively narrow the discount rather than just, hope that the manager does the right thing, or, just see if, trading dynamics change or whatnot. So that is an area that we are interested in having exposure to, and that Saba has been active and successful in doing. They've done over 90 corporate actions so far. And it isn't always an instant close of the discount. Like the example below is the Salient Fund. If you go to the next page, you can see the Bloomberg chart here. The funny looking red chart, the red filled chart, is the discount over time. So at the green circle shows near the bottom part is where the discount was. And then once the action was taken to merge the fund, the discount just, shoots up from, the teens to the mid single digits and eventually closes. So that's what we're going for in having a portfolio like this. So we'd still maintain exposure to some interesting assets, but also have someone that's working to close the discounts and find the best opportunities among the closed-end fund universe to do that.
Any questions? This is different, and that's good. As I say, you can see the sources here are not really relevant to the level of the stock market or the level of the of interest rates, although these funds do generate a pretty sizable cash flow. So if nothing happens, if Saba is unable to get any of this agreement with the manager or owner manager of the fund to make any moves to eliminate the discount, it is a nice current return, but that's not what they're there for. They're picking these as vulnerable and open to not necessarily open, but the ability to reduce that discount from book value.
And it's a relatively large, I think, as Anthony mentioned, the universe of potential funds to invest in is, I think on slide 129, he says 440 billion across over 735 funds. So there's a significant universe. And again, that it ebbs and flows over time. I think we've seen, it's interesting, the persistence of discounts, as Anthony mentioned, and then when we get what we would call dislocated discounts. So when they breach certain levels and they become of interest to Saba, that universe is changing, but it's fairly, the opportunity set is fairly persistent in, the size may change, but there's always a number of opportunities out there with significant discounts. And they've been successful in their approach to, as he mentions, the activist investing. And I think one of the interesting comments on one of the calls we had, sometimes just knowing that they've been involved, once their name comes up that they're involved, the sponsoring firm, the manager, tends to take action even without them necessitating any activism. Just the fact that they're involved and they know what the objective is, they work to close that discount even with Saba not having to do anything. So this is, as Pruitt said, it's a really interesting opportunity. I think it's very unique. It's a nice fit and complement in the space, and that's, the source of return here is going to be something that's pretty standalone and unique. Can be asymmetric, as he mentions. It's a little different from that risk reward profile. So I think it's a differentiated for sure. I think Ramsey had a question. No, I'm sorry, I'm Dave.
Sorry, did you say I could ask my question?
Well, it is, yes, go ahead.
Okay, sorry, yeah. What would the average holding period be for one of the closed-end funds that they're buying?
Yeah, the campaigns, they think it's a 1 to 1.25 years. I think it could be up to 2 years. They did think that they could have, they were hopeful that they were going to get some of the activism done with BlackRock last year, but that's continued. And, so the courts have ruled on some things since then. So that's part of why I think the catalyst is a bit closer. The meeting that we're talking about is in July for them. So that's kind of when we resumed talking to them again in maybe last March or so. And over time, that they've pursued the litigation and things like that. And so they think that the opportunity is important before July, so they can continue accumulating the shares and the voting power.
And does the litigation put us at any risk? What if, if BlackRock decides okay, we're going to fight this till we spend $200 million or something?
Sure, BlackRock is fighting. I mean, we don't have to do. I mean, I think Saba has its obviously legal costs, and it's funding that, but
so that none of our investment would go towards the legal fight.
There's some expense for that. I mean, but I think it's part of the expenses and fees they have, both for us and all the funds. So they have a flagship product. We are just focused on the closed-end funds, but which can allocate across different strategies they do. But right now, closed-end fund is their highest conviction area. It's almost half of the flagship right now. So
could they call any more money and say okay, we're having this fight, we need another 75 million?
No, I think that's already in. Well, I mean, a lot of these are already in process, but I think that they would just, utilize what the money that they have.
Yeah,
so we would just giving what if we give 75, then that's it. We're done.
Yeah, they couldn't call beyond the 75. Now, I mean, we could have discussions about whether or not we could upsize if there was some opportunity, and that would probably be more for, if another opportunity came up, another fund,
Mhm.
another something that they wanted, and they said, man, this is, it's a three bagger, right? It's not something
Mhm.
unrealistic that it's a great opportunity if you had additional capital to deploy, but they couldn't call beyond what we had.
Right.
So
Yeah,
and
and that
as
happens.
far-
I mean, another
Additionally,
majors in that. Go ahead,
I'm,
Vicky.
I'm sorry, I was gonna say additionally, they can't use all, say it's 75 million for litigation towards one of the investments, because when we go in as, I guess, equal partner, if you want to call it there. So if there's, like 45 investments in that fund, our 75 million gets divided 45 ways. And so there is, as Anthony, said, some exposure based upon fees and expenses, but it's our proportionate share of the fees and expenses to that one investment within the fund as a whole.
So
Good
Steve,
clarification.
in the category of keeping it simple, explain to me what the upside is to putting our money here as opposed to just putting it in a fully indexed S&P mutual fund.
Well, I think what we look at here is, there you're gonna be at the behest of the market, right? I mean, we'll go up, we'll go down. Markets might be up, markets might be down.
So talk to me about that counter-cyclical bonus with this particular strategy. How either as a result of past performance or as a result of your understanding of this opportunity, we are hedging our bets against, for example, drops in equity.
So the performance generation, so the ability, this is the differentiated source of return. So if we're not dependent on directionality of the market, so even in a down market, there's still the opportunity for them to be activists or for them to take a position in a deeply discounted closed-end fund and create performance. So if we think of the performance purely in isolation for this investment, and the driver of our performance is, as Anthony mentioned, closing that discount, the chart he shows. So it's not dependent on level of markets, but the ability to close that discount. And again, we're looking at 15+% return essentially when we close that discount. So, and it's not directionally dependent on where markets are. That it's more dependent on the opportunity of the discount and the ability to close it. So where if we have it in the S&P, we're going to be very dependent on growth, economic growth, and the tide's lifting all boats. And so we're gonna wear whatever the performance of the general market is. There could be an opportunity, the markets could be down, but we could still be generating performance from closing discounts and funds.
And so, Steve, if this is such a great idea and Saba has sort of a niche here, what happens when everybody else figures this out?
There's a reason why people haven't done it a lot, and it's because a lot of even the activists like your Elliots and other big hedge funds of the world, they need those people for voting when they're voting on other stuff. Like if they're going to go active against some other stock that they're interested in, who are the largest holders of every public equity today? BlackRock and Vanguard, right? So are you going to go piss off BlackRock and sue them because they aren't closing their closed-end funds, or are you going to play nice and not do that, right? So that's one reason why people aren't doing that. And there are some followers, right? So some you can see in some of the holders tabs, there's a few hedge funds like kind of your Citadels and Millennium spinouts, or other people who are in a few of these names because they see what's going on. Your D Shaws of the world, some of the people who kind of see what's going on and can do it. But as far as a dedicated strategy and then being out front to do that, no. And these aren't the most liquid markets, so that's always something that we were mindful of. But they have accumulated quite a lot about it, and that does require block trading and steady buying, right? Because I mean, some of these funds are not even their own funds. They have two of their own closed-end funds, which are too small for us to look at. They're I think 160 and 300-ish million. So that's just not implementable for us. But what they're able to do in some of these funds is come up with larger stakes and then do this across the market, and that's what they've been able to do for several years now.
So, Anthony, what other similarly situated public pension funds have a relationship with Saba as a manager?
Sure. They have They have several, a couple foundations as well. I know one that a university foundation that just went into the flagship because we talked as references. There is another university in Texas that's involved. I talked with several clients and also some people who passed on it or have redeemed. So there's a range. There's definitely some. We're not the first pension clients. So.
And is there any risk that by engaging in this kind of transactional activism that the headline could say Kentucky Pension Fund is invested in an entity, has funds under management that has either adversely impacted the municipal bond market in Kentucky or otherwise detrimentally impacted some Kentucky corporation or business?
Well, I can maybe answer that a little bit from my background. There is no Kentucky closed-end fund anymore, or one it's maybe kind of dead. It has about 10 or 15 million dollars in it. So they would not be obviously the closed-end single state closed-end funds are high tax states, i.e. California, New York, New Jersey, others, Massachusetts, I think has several, not Florida, but so I've thought about this. Is there any impact in ESG? Is there any impact to issuance in Kentucky? And I can't come up with any.
Good. And I would also, again, not to speculate, but there's with shareholders. So as Anthony mentioned, a lot of the typical shareholders of these funds are smaller individuals, retail, and the benefit ultimately of closing that discount is a benefit to those individual investors.
Yeah.
If I were to speculate as to the press, which side am I going to be on, in favor of the individual investor and doing a benefit for ultimately unlocking the real value and to the benefit of those investors seems like a good side to be on.
Right.
Yeah.
And
Robin,
similarly here, you get to be on the side of the ESG in terms of, BlackRock have, for better or for worse, has been out front on this stuff. And, this just highlights hypocrisy, right? The G of ESG is governance, right? And so the governance that is doing right for all shareholders is, pretty obvious. And so that's something that, Saba's been highlighting and is, litigating as well. And that's kind of, it benefits many and, and maybe mildly impacts a few negatively, which is the management. So.
Ramsey, I believe you have a question.
Yeah, sorry. How much were we talking about? I think it was 75 million, but I can't find it.
That's right.
Is that correct?
It's about, it is correct. It's to make around a 1% position for the plans.
Okay, so and that would go towards back to the discussion we were having earlier. Wilshire, is that illiquid assets? Would that be considered?
It's in the illiquid bucket. That real return bucket is assumed to be all illiquid assets.
Okay.
Less liquid, whichever. Liquidity scores are low.
Got
For
it.
that asset class.
Thank you.
And that commitment would be, as we have done, spread across essentially the 6 portfolios, pension and the 3 pension, 3 insurance portfolios. And from a funding perspective, we're still short of our target, even the revised target for that real return asset class. So this is obviously moving us in the right direction, continues to move us in the right direction. Depending on portfolio specifics, we have cash that can be deployed, and we also have proxy assets that could be liquidated. These are liquid proxy assets that could be liquidated for minimal transaction costs that would be used to fund this.
And Steve, are there any thresholds with regards to the amount of the investment that would impact the cost of management? In other words, if it's 50 million, it's one cost. If it's 75, it's another. If you get to 100, it reduces the transaction cost significantly. Any plateau? I mean, I guess I'm looking at why 75
break points and stuff. Yeah. I think the quote that we have right now is we are thinking of a 1% of everything. Obviously we go through 2 boards and investment committees, but that's kind of, I think the rate reflects that right now.
That's a good question.
Mhm.
It is interesting. It's, not the, the good news is it's not the mainstream that we usually bring to the committee. And these are great questions.
Mhm.
Any additional questions? Well, that said, I'd like to have a motion for across the board, the K plans to invest 75 million and with as stated here with Saba Management.
And as always, it's contingent on successful negotiation of agreements. Just always
Yes.
want to put that in there.
So moved with that caveat included in the motion.
Mhm.
We have a,
Second.
did I hear a second?
Second.
Great, thank you very much, Ramsey. So we'll take a acclamation vote. All those in favor say aye.
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 And all those opposed say no. Hearing none, the motion passes. And also hearing none, I believe we've reached the end of our agenda. And it's lunchtime somewhere. It is lunchtime.
Yeah.
Well, appreciate everyone's time.
Yeah.
I know that was
Thank you
longer
very much.
than we had hoped, but I think we got a lot accomplished. Great questions. Really
Yes.
appreciate the discussion and the dialogue. And we're excited about the opportunity. So thank you very much.
Well, Steve, to you and Wilshire, I know a lot of work went into this, but it was cogent, organized, well delivered, context provided. So kudos to making something that ostensibly is very complicated, easy to understand, and particularly presenting scenarios for choices. I just appreciate all of the hard work and thoughtfulness that went into this, both with our friends at Wilshire and you and your team. So thank you for
Well,
that.
thank you very much. We appreciate everyone's time.
Yeah, we do too. Thank you so much.
All right, with that, we have adjourned and wish everyone, I just was noticing on the Lexington, it said that stay